This market continues to break new records. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a record run. Progress on trade boosting sentiment as volatile first half comes to an end. Meanwhile, on Capitol Hill, Trump's big, beautiful tax bill nears the finish line, but major hurdles remain. And we'll discuss it all with Scott Bessent, the Treasury Secretary, joins Open Interest later this hour. Katie, what are the stocks you're watching?
Let's take a look at the big banks. We start with Goldman Sachs, among the banks moving higher this morning after passing the Fed's annual stress test on Friday, really setting the stage for bigger buybacks and dividends for shareholders. Shareholders like that. You can see shares up 4% for Goldman Sachs.
And as we continue your drumbeat to the opening bell, let's take a look at Tesla. It's the only Mag 7 stock that's down in the pre-market trade, only 0.7%, but the Senate tax bill plans to phase out clean energy credits faster than previously expected. We're talking, Katie, September.
Well, before we get to September, let's talk about the end of the first half, because we may be closing out the first half of the year at a record high for the S&P 500, but U.S. markets are lagging the rest of the world as trade and interest rate uncertainty muddy earnings growth. In fact, Bloomberg intelligence analysts say that American companies no longer lead in projected earnings growth across any major tech themes. Europe and Asia have instead taken the lead. Let's break it down with Bloomberg managing editor for Markets Live, Katrina. She joins us now. And so for so long, when it came to this European outperformance, you could write it off as this isn't going to be sustainable. We are 6 months into the year. It feels like we can't ignore Europe anymore.
Yeah, absolutely, Katie. And what a sea change from years past, right? I mean, we've always been talking about how Europe could just never catch up to the U.S. because it doesn't have as deep or as big of a tech sector. But that's changing now. And that's largely thanks to some gains in frontier tech markets and also defense companies that fall under that tech sector in Europe. That's really driving this analysis by Bloomberg Intelligence, right? That's really what's given both Europe and Asia the edge, in particular South Korea and Germany leading the way.
So who in tech overseas is doing better than tech here? I mean, I saw a Bloomberg Intelligence story this morning saying that they're leading the way.
Yeah, well, Matt, I mean, it really is those companies in those sectors, right? Like modern defense and a frontier tech. So a lot of these kind of sectors you would say that are probably still in its infancy stages. And that's probably how some of these companies have kind of gotten the edge in the U.S. Because in the U.S., it's still a lot of focus on AI, semiconductors, all the Magnificent Seven stocks. And to be clear, that is still very much the purview of American companies. The 11 tech bellwethers dominated still by U.S. companies. But it's really kind of some of these sectors that are probably less developed, less looked at, that Europe and Asia have managed to get the edge.
Well, let's talk a little bit more about the U.S. because Friday we finally closed out at that record high in the pre-market. You can see the color is green, so that means we'll open at 1-2. Even though we're only looking at year-to-date gains of about 5%, we've finally broken that record. Talk to us about the different components that led us there, because you take a walk down sell-side research and there's still a lot of negativity out there.
Yeah, absolutely, Katie. I mean, you know, you would expect some of the biggest sectors, again, your big tech leading the way, but that's because they were also the ones that were most battered, particularly when markets were digesting through the initial reciprocal tariffs that were unveiled on Liberation Day in early April, right? And so they're the ones that really bounced back the most because they were battered the most to begin with. And so, you know, I think the question now is, again, we have that July 9 trade deadline that President Trump is still talking about and kind of dangling over a lot of the U.S. trading partners. But then also we have earnings season that is meant to be beginning in earnest later this month. And so really the question is, look, we've had this euphoria because we've reached yet another record high for the S&P 500. Can that really be sustained given that we do have a couple of big risk events ahead here?
Yeah, absolutely. A lot of risk events coming this week, even though it's a shortened week. We have, of course, the Senate voting on the big, beautiful tax bill. We have Jobs Day on Thursday, and we're just generally on trade deal watch. So a lot to keep an eye on in what's supposed to be a holiday week. Katrina, great to see you. That is our Markets Live managing editor. Let's talk a little bit about one of those risk events, because President Trump's big, beautiful tax bill faces a marathon voting session in the Senate today. Majority Leader John Thune is working to get it passed by that July 4th deadline, but faces a torn GOP. Henrietta Trey's of Veda Partners, she spoke about the bill this morning on Bloomberg Radio.
There are millions of individuals at risk of losing Medicaid in this package, and that will be a big amendment vote from Rick Scott, Republican of Florida, that will need to pass. Otherwise, it could risk as many as 4 Republican senators defecting away from this bill, and it will pave the way for increasing the deficit by $4 trillion without paying for it in this package. So a lot is very heavy stuff on the line today.
Joining us with the latest is Bloomberg's Washington correspondent Tyler Kendall. And Tyler, she was talking there to Tom Keene and Paul Sweeney about the vote-a-rama in the Senate. What kind of drama should we expect?
Yeah, hey, Matt. So the vote-a-rama is actually starting right now. The Senate is convening at 9 a.m. Eastern. And essentially, we're going to see Democrats, but also, as you heard Henrietta mention, Republicans to put forward amendments that's going to force some pretty politically fraught votes in a bid to, 1, get priorities through, but 2, drag on this process. And drag it on they could. The vote-a-rama is expected to go potentially up to 12 hours. But once that's done, then we would see the vote on the finalized passage of the Senate bill. So potentially we're teeing up for this vote to pass as early as tonight or tomorrow morning. But that would mean that Senate Majority Leader John Thune got enough votes to get it over the finish line. And at the moment, he doesn't have that. In fact, we already know of 2 pretty likely no's. One is Senator Tom Tillis, a Republican from North Carolina. He's concerned about those cuts to Medicaid, also how quickly some of these clean energy tax credits are being phased out. But then on the other side, the other likely no is Senator Rand Paul of Kentucky, who wants to see deeper spending cuts and also won't vote for anything that lifts the debt ceiling. And Matt, that really puts into context here the fissures on both sides. We have agreement within the Republican Party when it comes to the pillars of this package and those tax cuts, but they are really divided on the spending cut portions of this bill.
Yeah, absolutely. And just give us an update on some of the most contentious issues that we've been talking about. I'll ask for Matt. I'm specifically asking about salt. What is the latest wrangling there?
Definitely. So that's going to be an issue when they kick this back over to the House. But it does appear that they have made some sort of progress on a compromise. We are expecting them to vote and approve on keeping that cap at $40,000 for 5 years. That is lower than the original 10 years that the House had proposed. We haven't heard from all of the so-called SALT caucus, but it does appear that this deal is enough to get them on board. But in order to get this over to the House, that's going to be one of the big things. But we're not expecting it really to come up in the Senate version of this bill. The 2 main threads that we're watching is, one, when it comes to potential cuts on Medicaid and lowering the Medicaid provider tax. Republicans did get some sort of a win in a compromise in that provider tax is going to be lowered in a smaller timeline that's going to go into effect in 2027 instead of 2026. That is considered to be a win, but it's still proving to be a really politically fraught issue on the Senate side. But then compare that to the House, Katie, and that's where we're really going to expect some of these more fiscal hawks to dig in, these members of the House Freedom Caucus, names like Chip Roy, for example, who have already said that they are not liking how this Senate bill is shaking out. Those are the ones really to watch because they're less afraid to buck President Trump in this way, since they really did campaign on trying to reduce the national debt.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there in Washington as the vote-a-rama kicks off in the Senate. Let's get to the other top story in Washington, which is trade talks. Canada advancing U.S. talks by agreeing to rescind its digital services tax. U.S. Secretary of Commerce Howard Lutnick praising the move on X, calling the tax deal a deal breaker for any trade deal and thanking the Canadians for removing it. For more, we're joined by Brendan Murray. He leads Bloomberg's trade coverage. And Brendan, this brings up again a question I would have for anybody in the Trump administration. Are these tariffs meant to be a negotiating tool to bring us down to a lower tariff world, or are they meant to raise revenue and offset the spending cuts and tax cuts?
Yeah, well, I think the Trump administration has demonstrated that they're a multi-use tool. They're not just negotiating leverage, but they can raise revenue. And ultimately, as President said throughout the campaign trail last year, he wants to reshore jobs that have gone overseas. What we saw with Canada over the weekend was we've seen the president use tariffs to help big U.S. steel companies. We've seen him use tariffs to help the big three automakers. And now he's using his leverage in these trade negotiations to help the big tech companies that don't like these taxes that they're exposed to overseas. Canada is not the only country that's in negotiations right now with the U.S. That has digital services taxes that the U.S. will certainly try to use its leverage over to try to ensure that they don't go into force. There are digital services taxes in Europe, in Asia, in some emerging markets. So what we've seen now is the president come out with one of these sort of asymmetrical tools, this threat of I'm going to walk away from the negotiating table if you have this digital services taxes imposed, which is something that would have been a reminder to all the countries, dozens of them actually, that are negotiating down to the last 9 or 10 days here to the July 9th deadline.
And here we are in that final home stretch. Certainly a lot of headline risk when it comes to potential trade negotiations this week. Bloomberg's Brendan Murray will be on top of it all. Let's take a quick check on futures here. We're about 20 minutes away from that opening bell. You can see the S&P 500 looking to continue its record-breaking streak, up about 0.4%. Big tech leading the way, and the small caps also getting in on the action. Let's talk about some specific movers here, Matt Miller. And I want to start with renewable energy stocks. They were down, but they're now climbing. I do want to point out that there is some idiosyncratic risk here. Sunrun, for example, was up more than 8%. That's because even though it would see its ability to receive tax credits limited, it might be still open to other specific things. So you have to drill down here. You can see that First Solar, also one of those idiosyncratic movers. Oracle, too, having a great start to this week. Yeah, Oracle's CEO saying it signed multiple large cloud services agreements, including one that'll bring in more than $30 billion in annual revenue starting in 2028. So Oracle shares up more than 7% as well. And the Home Depot story I find interesting. Did they get GMS for less than QXO? It kind of looks like it. $4.3 billion is the final price tag for that building products distributor, GMS. You can see it's up 11% right now. Just one of several deal headlines today. You also have HPE and Juniper Networks rising after that DOJ settlement as well. Yeah, I thought QXO was willing to give $6 billion. So seeing 4.3 from Home Depot take the win is masterful to be sure. Coming up, we're going to dive into the winners and losers of the first half of 2025. Remember, this is the last trading day of the first half. And then after that, don't miss a conversation with Treasury Secretary Scott Bessent right here after the opening bell. This is Open Interest. Let's get now to high interest and look at what's making headlines around the world. Nintendo is pulling its products from Amazon's U.S. website after a disagreement over unauthorized sales. That means Amazon will miss out on the recent debut of Nintendo's Switch 2, the biggest game console launch of all time, or so I'm told. The Justice Department has settled its lawsuit challenging Hewlett-Packard Enterprise's $13 billion acquisition of Juniper Networks. The decision clears a key hurdle for the takeover, and these shares, unlike Amazon's, are reacting to that news. Moderna's experimental flu shot hit its goal, showing a 27% higher efficacy than licensed flu vaccines in adults over 50 years old. The result set the stage for Moderna to offer a single shot that protects against COVID and flu, and those shares are up 3.5%, Katie. Yeah, some needed good news for Moderna there. Let's talk about sectors, though, given that we are on the cusp of the second half of 2025. You have three sectors in the S&P 500, energy, healthcare, and consumer discretionary in the red, but you can see more green on the screen because it was a pretty good first half. Let's break down some of the biggest winners and losers in the S&P 500 with Bloomberg cross-asset reporter Emily Graffeo. Let's start with the good news. Who did well this first half?
Okay, so like you said, the energy names did well. Not all of them, though. We'll talk about solar names in the laggards. But first, for the gainers, NRG Energy was up 80% so far this year. It's an owner and operator of power generating facilities. So it plays on that theme of needing more data centers to power AI. Investors here are really seeing it getting a boost. Again, on that AI theme, Palantir is another one on fire yet again. It was up 340%. Last year, and it's up again this year. As a reminder, this is a data company. They work with both companies, but also the U.S. government, and it's getting an extra boost this year because analysts are saying that it's winning more business from the Trump administration. So that stock up 72% year to date. Another name kind of in that similar theme, Howmet Aerospace. I have to admit, hadn't heard of this company, but I should have because it is up, again, another 70% this year. It's a jet engine manufacturer. Similar, again, theme here to Palantir. Analysts say the profit is firmly pegged to commercial aerospace and defense engine demand. And then finally, we still have a tech name among the top four, Seagate Technology. It's a data storage company, but again, that kind of tech play AI name driving the gains this year.
I do think it's cool to point out that the biggest gainer on an individual basis is an energy name, but the sector overall is in negative territory for the first half.
Dude, I think it's crazy that we've never heard of Howmet Aerospace, and it's a $75 billion company.
Well, now it is after that first.
Am I the only one that hasn't heard of it, or
No,
am I missing something?
No, and
I'm just making sure.
even before this, it was worth $40 billion, $45 billion. You'd think if somebody said, hey, I work for this company, and you say, I never heard of it, and they say, it's worth $45 billion, you'd feel pretty silly. Okay, in terms of the biggest losers, I guess Deckers is the #1 biggest loser year to date. And I always think that this is a company that makes like home improvement goods.
Right.
Like a deck.
Right, but it's not. It's an Uggs owner.
Shoemaker, right?
Yeah.
So they make Uggs, they make Hokas.
Thank you.
When I saw that they were, among the laggards, and I knew it was
Katie.
coming on Katie's show, I was like, oh my God, she's going to be so disappointed. But I feel like the laggards are kind of painting this picture of consumers pulling away from buying clothes and also solar panels. We'll get to that. But Deckers Outdoor, they provided a disappointing first quarter forecast in the latest earnings. I guess people just aren't buying as many Hokas and Uggs.
I buy Hokas twice a year, so I'm doing what I can.
Yeah, you might be the only one. There's a lot of competition in that space, in the sneaker space, and then also the athleisure space. Lululemon was, again, among one of those laggards of the year. They also cited...
What is the competition there? Because...
For Lulu?
Yeah, I mean, I know that you can go a little bit down market, right, with Athleta, but there's no other gold standard of yoga pants than Lululemon, right?
Aloe yoga.
Yeah, there's Beyond Yoga. Everyone is onto the athleisure theme. If you're a retail...
But isn't Aloe the same thing and they just increase the price by 50%?
Yeah, but
what's the difference?
People feel like it's more premium. But there is competition in this space. In fact, they actually... Lululemon is getting in a spat with Costco right now for potential trademark issues because, again, Costco's kind of trying to use that athleisure feel and that premium feel in their products. We also have Enphase Energy, solar names getting a hit. You guys were talking about the tax credit potentially changing for solar names, and then also United Health. That company has been hit very hard this year. The earnings haven't been great. There's been management shakeups, and then it's been facing multiple investigations from the DOJ over billing and antitrust issues in the Medicare program. So consumer, health, and then also solar names getting hit.
All right, Emily, thanks so much for joining us. Bloomberg's Emily Grafeo rounding up the winners and losers in the first half. Remember, this is the last trading day of the first half. As we continue to beat the drum to the opening bell here on Open Interest, check out some more movers. U.S. banks, after they comfortably passed the Fed's annual stress test. I say this is a pretty big story here. Goldman Sachs up almost 4%. And then ING, it is cutting 230 jobs, saying they have too many senior roles. There's too many managers. Who thinks that about their employee? ING shares actually down 1.6% in the pre-market.
Shareholders say, actually, we need more managers. In any case, we are just a couple minutes away from the opening bells. Franklin Templeton's Katrina Dudley says that markets will grind higher thanks to a stable economy, inflation that's under control, and trade deals in sight. But other strategists aren't so optimistic. And after that, don't miss a conversation with U.S. Treasury Secretary Scott Bessent right here after the opening bell. This is Bloomberg. Welcome back to Open Interest. And Wall Street strategists seem to agree that there will be rate cuts this year, but the impact on equities is anyone's guess. Morgan Stanley's Mike Wilson says that U.S. stocks are likely to get a boost from Fed rate cuts, while you have J.P. Morgan seeing less support for U.S. shares and anticipates that the Fed will reduce rates against the backdrop of weaker labor data and higher inflation driven by tariffs. Let's break down what the next 6 months look like with Katrina Dudley. She is senior investment strategist over at Franklin Templeton Public Markets. Great to have you with us, Katrina.
Great. Thanks for having me.
So let's talk about the Fed, because as I said, it seems like that's the consensus. So we will get some form of rate cuts from the central bank. What does that mean for equity markets, though?
Why are they going to cut rates? I mean, we're looking at an economy that's actually been very resilient. And if I go back even post-Liberation Day, we were looking at recession fears, and that was really the downdraft in the market. But if I look at it, the economy's been very resilient. The job market is holding in there, and inflation has been tame, but it's not quite there. It's close. So why are they going to cut rates if the economy doesn't need it? So we're not in the camp that we see 2 more rate cuts going into the end of the year.
They are getting a lot of pressure from the White House. I don't know if you heard Donald Trump on Friday. He wants them to cut 300 basis points.
Yeah, and look, I think that we do need to respect the fact that the Fed is an independent entity. So I think they listen to the president, which is fine. But I do think that realistically, we are in the camp of we're definitely not in a camp of 300, but we're actually not even confident that you'll get 1.
Okay, so not even 25. Katrina Dudley, you're going to stay with us through the opening bell. We are looking at a potentially new record on the S&P 500. Obviously, we closed at a record on Friday and just pushed up. The question is, why are people buying this market? Is it just companies buying their shares back? We'll talk about that on the other side of this break. This is Bloomberg. Just seconds away from the opening bell. This is Bloomberg Open Interest. I'm Matt Miller. We saw a new record close on Friday. We will see new intraday record highs as soon as this market opens up. You can see S&P futures up 0.4%, NASDAQ futures gaining more than 0.5%. You hear the opening bell on the New York Stock Exchange, and I'm pretty excited to see Verizon ringing the opening bell. Why, Matt, you ask? Because it's the 25th anniversary of their founding. I will never forget the breakup of Ma Bell as a kid, and this is the delayed result of that Bell Atlantic getting together with GTE to form Verizon 25 years ago. Down at the NASDAQ, Alarm.com ringing the opening bell. Their stock is down 13% over the last 5 years. So not great.
Not great. Not horrible, though, compared to some of the bell ringers that we see.
Fair.
Should we talk about Goldman Sachs?
Yes. Banks, I think, are a hot topic today.
Yeah, banks ripping this morning to start the week. Goldman Sachs, just one of them, moving higher after passing the Fed's annual stress test. That was kind of expected, but this really sets the stage for bigger buybacks and dividends for shareholders. Obviously, shareholders seem to like that. You can see Goldman up about 3% right now. If you round up, was up even higher pre-market. It'll be fun to watch these financials throughout the day, Matt.
Yeah, I mean, I was thinking about this morning. You don't really see them failing stress tests very often, right? Like maybe they should fail one, just for each time.
The drama.
Like grade on the curve.
Yeah.
Tesla grading on the curve is not doing well compared to the rest of the Mag 7. It is up 0.25%, but in the pre-market, it was the only one trading down. The reason for a little bit of negativity, and you can only get so negative on a stock that's driven by retail traders. The Senate tax bill plans to phase out clean energy credits faster than previously expected. Basically, by September, as the draft looks right now, you will no longer get $7,500 back if you buy a Tesla or any electric vehicle. All right, we're back with Katrina Dudley, Senior Investment Strategist at Franklin Templeton Public Markets. And before I get to, I wanted to talk about buybacks, corporate buybacks, Katrina. But just quickly on the banks. Katie makes a great point. They always pass the stress test. Like, who cares?
Actually, you don't want them to fail, do we? Okay,
No,
let's
of
be
course not.
very, very
That would
clear
be
here.
super bad.
That would be super negative for the markets generally. It wouldn't just be that one bad bank that failed. It would have reverberations. So let's not talk about that. But why are they doing better? Yes, it's share buybacks. I agree. It's passing those stress tests. But let's talk about it. It's the economy. It's a good economy. It's been a resilient economy, number one. Number two, we're starting to see deals. So you look at a Goldman Sachs, deals mean profits for them. So you have, from that perspective, a lot of good things going on, particularly for these investment banks. So I think that there's more room to run there.
Yeah, absolutely. Great point on deals. And just today, it feels like there's several deals to really dig into. So all of that adds up to good news for financials. Let's talk a little bit about buybacks, though. As Matt mentions, I believe it was a Deutsche Bank note that was making the case this morning that the rally that we're seeing is built on buybacks. It's built on companies buying back their shares. Would you go that far?
It's a component of the returns, but if I have a look, we've had a rally. We've had after you've had such a big correction, this is the fastest comeback to an all-time high we've ever seen. It was even faster than the long-term capital management recovery, which was 60 days. We got back to all-time highs in 58. So I think that that's the thing that's concerning people. But it's not just the buybacks that have driven this rally. It has been the resolution of the tariff uncertainty. It has been the economic resilience that we've continued to see in this market. So I don't just think it's buybacks that have driven that rally of such a significant stature.
Are valuations a concern to you at this point?
Valuations are an indicator, but when you're looking at valuations, you cannot just look at valuations alone. You need to look at what is the underlying earnings growth and what's the breadth of that earnings growth. We have seen a broadening out of earnings growth, but one of the things that does concern us is a lot of this rally has been very concentrated.
Right.
It hasn't been the broad rally that you would like, that we were actually anticipating at the beginning of this year, where we talked about the average stock doing well.
Right.
It's actually been a little more concentrated into the industrials, the IT, and the comm services. So that's the thing that just keeps us a little cautious, is the fact that it is a concentrated rally.
That you don't see that big, beautiful breadth that maybe some had been waiting for. Yeah. I want to talk a little bit about who's buying, because a consistent theme that seems to have emerged is that you have retail rock solid there. When it comes to the typical institutional investor, are we seeing that same sort of appetite to propel stocks forward?
Smart money versus dumb money.
I think that all money is money, okay? So, and the fact is, if
all money is good money.
Exactly. So what is driving it? Have a look at what we're looking at. If I go back, we've got a resilient economy, and I want to keep coming back to that, because an economy that is resilient and strong drives earnings growth, and earnings growth is what drives market forward. And if you look at the propelling a market forward, investors have to be there. They can't be sitting on high levels of cash on the sideline when the market continues to move away from them. So I think that it's investors staying off the sidelines, keeping out of cash, that is really driving the market. And the other thing too is that if I have a look, you've got an underlying support, as you've said, from the share buybacks, and then the final leg of this rally, I do think, is going to be M&A, which I expect to accelerate into the second half and into next year.
All right, good note to end on there, Katrina. Thanks so much for coming in today, Katrina, Dudley, Franklin Templeton. Looking forward to more M&A and, of course, encouraging inclusiveness when it comes to cash. This is Bloomberg Open Interest. Let's get a check on what's going on in stocks. Just 5 minutes after the bell, but we again have an intraday record here on the S&P 500. 6186 is the level that we're looking at now, and we've been hitting new records on the NASDAQ as well.
Absolutely. Take a look at what's driving it. Communication services is actually your biggest gain when it comes to the sector level financials.
Verizon is a communication service.
Absolutely.
Do you know that today is the 25th anniversary of the forming of Verizon?
I heard you say that at 9:30, and I was hoping that you were going to say it again, and you did.
Literally today.
Literally today, the 30th. Well, coming up, Treasury Secretary Scott Bessent is in the building. We're going to hear from him up next. That conversation you don't want to miss.
This is Open Interest. You're looking live at the Principal Room. Coming up in the next hour, an interview with Bryan Fairbanks, the CEO of Trex, which actually does make decking products. This is Bloomberg.
We now welcome our Bloomberg television and radio audiences worldwide. I'm Shanali Basak, and we are now joined by U.S. Treasury Secretary Scott Bessent, just as the Senate has begun voting on what's known as the Big Beautiful Bill. You look at the latest version of the tax bill, the big question that remains is the GOP holdouts. What kind of deal can be cut with those holdouts, and what are you and the president prepared to offer for support?
Well, I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like. So President Trump, then the Speaker Johnson, Leader Thune, and at the committee level, Senator Crapo and Chairman Jason Smith have been fantastic to work with. And again, it all goes back to leadership.
Now, when it comes to the fiscal hawks, has the administration made any assurances about executive orders or legislation down the road to address the national debt load?
Well, I think everyone believes that this is a start. So it's an 11% cut in non-discretionary spending. And we're going to go from there. So we didn't get here all at once. We've gotten here 20 or 40 years, and we are going to bend the curve, bring the debt levels down. I'm a fiscal hawk. I've had a lot of very good meetings with that group. And I think we're all on the same page on how to grow the economy while controlling and bringing down expenses.
Now, let's talk about some of the math there as well, because if the GOP is right and the bill does look to shrink the deficit, how will that affect Treasury issuance over the next 10 years? How does your math square with the CBO, with Wharton, with Yale, and even the Bloomberg consensus of GDP projectors here, economists, that still see growth under 2%?
Well, I think that's just wrong. And, we can start with the CBO. Is their model presumes 1.8% forever. And maybe under Democratic governments, that's right. I think what we saw under President Trump's first term is that we will get a big boost in the economy from the tax bill. We're going to have certainty. We're going to go back to 100% expensing. So we are also deregulating at the same time. So we saw it in Trump 1.0. I think that we can see it here. So I think we can really accelerate the economy, because the CBO model shows 1.8% growth, whether we have the biggest tax cut in history or we get this across the line and give companies and consumers great certainty.
You mentioned that the spending cuts were just a start. Now, which will prevail when you think about the cuts specifically as it pertains to Medicaid? Will the House level of cuts to Medicaid prevail, or the Senate level? And which one will the president support?
We'll see. My sense is, and again, I take exception to cuts. We are actually bending the curve further out. We are getting able-bodied people back to work, and the most needy will have greater benefits.
Well, the main question, too, is the benefits that are being cut. What do you tell the nearly 12 million people that are on the brink of losing access to Medicaid?
Well, no, again, that's not right. 1.4 million are illegal aliens. Then a huge percent of that are the able-bodied working people who will need to go back to work. So we're going to have a work requirement, and we'll go from there. We're just going back to the levels pre-COVID.
So given where the bill is, how does the latest bill impact the trajectory of the debt and deficit in your view?
Well, again, that I think as we accelerate growth, an increased growth trajectory completely changes the debt dynamics. So what we're focusing on is the debt to GDP. We're going to start bringing that back down. We are going to pull down the deficit to GDP. And I think we will be turning both of those down over the next year.
Does it give you, though, enough confidence to start terming out the debt? At what point do you start issuing at longer dated maturities?
Well, why would we do it at these rates? we are more than one standard deviation above the long term. We're more than one standard deviation above the long-term rate, so why would we do that? The time to have done that would have been in 20, 21, 22.
So a lot of people in the market point out to the success that has been in the bond market. You have seen the 10-year come down almost 0.5 percentage point since the January highs. Where would you like to see the 10-year, and where do you think it could end by the end of the year?
Well, I think it's going to depend on a lot of things, but I think that we could see a further lowering of rates. I think inflation is very, very tame. I'm not going to comment on Fed policy, but I've said that I am focusing on the 10-year. So as we see inflation come down, I think the whole curve could parallel shift down. And I'll point out, when everyone says, oh, the market, the bond market's worried about this or that in the U.S. U.S. is the only major bond market that has lower 10-year rates than any other country. Every other country, the rates are up.
While we're talking about interest rates and the Federal Reserve, it has been recently reported that you might be in consideration for the job as the next Fed chair. When you've been asked about the likelihood recently, you said that it's up to the president. Is it a job that you would want?
I will do what the president wants, but I think I have the best job in D.C. We're making a lot of progress with the president's leadership. Think about it. We are going to have the tax bill on his desk by July 4th. We're going to be wrapping up the trade talks. So I think we've had great momentum, and we will be working on Chair Powell's successor over the coming weeks and months.
You had mentioned that an announcement could be as early as October or November, and Powell's term ends in May of 2026. How is the street supposed to navigate between that announcement time and the time between the term being over for Chair Powell? You were the one, I want to remind people, that had brought up the idea of a shadow Fed chair prior to the election. Is a new appointee supposed to be considered that shadow Fed chair?
Well, not necessarily. We'll see. There's a seat opening up, a 14-year seat opening up in January. So we've given thought to the idea that perhaps that person would go on to become the chair when Jay Powell leaves in May, or we could appoint the new chair in May. Unfortunately, that's just a 2-year seat.
So ultimately, do you think that there could be some confusion?
Well, I don't see why there would be confusion, because obviously there are people who are currently at the Fed who are under consideration. So why would there be confusion if that you add another candidate in January?
So what about Fed policy as it stands today? The president has voiced his preference for lower interest rates. There have been investors, but also most recently the Bank of International Settlements, warning about any inflation risks tied to the tariff policy. Realistically, how much can the Fed lower rates this year? And what is the level and rate of unemployment that would suggest a faster pace of rate cuts? Economically, what has to slow?
Well, look, I said during my confirmation, I won't talk about the mistakes the Fed's going to make. I'll only talk about the ones they have made. They made a gigantic mistake in 2022. And as I like to point out, medical studies have shown that people who fall tend to look at their feet, which makes them fall more. And my worry here is that, having fallen down on the American people in 2022, Fed's now looking at their feet. We have seen no inflation from tariffs. If we do, which we don't have to, then there'd be a one-time price adjustment. Nothing is more transitory than that. So, Team Transitory, having failed the American people in 22, they seem a little frozen at the wheel here.
Part of this uncertainty does relate back to the trade deals. You've set a deadline for July 9th with key trading partners, or at least the administration in total has. How many of the key 18, the 18 most important partners that you have been speaking about have deals that will be agreed to by that time?
We'll see. I'm not going to negotiate on TV and let people off the hook. But as always, there's going to be a flurry going into the final week as the pressure increases.
What can you tell us about what's coming out of those deals? Are they inked deals or are they negotiations for future deals?
Well, what I can tell you is that the staff level, whether it's at Treasury, at USTR, at Commerce, people who've been around for 20 years are in amazement, and they're saying these countries are coming with offers that they can't believe. So in terms of bringing down tariffs, non-tariff trade barriers, we're leaving aside currency, the financing of the labor and capital in an advantageous way. All these countries are pulling back.
So you've said that trade negotiations could be wrapped up by Labor Day. How should investors and nations impacted be thinking about that July 9th deadline? And could that be pushed back to avoid going back to those April 2nd tariff rates?
Well, that's going to be up to President Trump. And I'm not going to tell any country. We have countries that are negotiating in good faith, but they should be aware that if we can't get across the line because they are being recalcitrant, then we could spring back to the April 2nd levels. I hope that won't have to happen.
So one other part of the tariff strategy that a lot of investors have been asking about is related to the housing affordability crisis. There's still Section 232 tariffs being seen as it pertains to lumber and timber. Those are key materials for housing construction. Are you in support of them ultimately, given where we are in the housing affordability crisis today?
Well, I think it's important to break down. So what we're negotiating now are the reciprocal tariffs. 232s take longer to implement. So we'll see what happens with those.
Also on the housing market, what kind of timeline? Well, first of all, is Fannie and Freddie going to be privatized? And what type of timeline would you look to do that on, while also ensuring that mortgage rates won't skyrocket on the heels of such a plan?
Well, let's work backwards on your question. Is anything we do, we will be focused on the mortgage rate, the spread of mortgages over treasuries, and ensuring that that does not move. But I can tell you that we have been busy with peace deals, trade deals, and tax deals. And once peace deals going well, tax deal done on July 4th, a trade deal wrapping up midsummer, and then we will focus on Fannie and Freddie.
One more question for you. Another thing that is making its way through Congress is legislation as it pertains to cryptocurrency, but right now stablecoin. Will this bill help in terms of making stablecoins a bigger force in the payments market, in the treasury market? Will they be a larger force of what absorbs new treasury supply?
Well, what you're referring to is the Genius Act. The Senate's passed it. It's now with the House. President Trump, myself, much of the Senate leadership, and many in the House are encouraging them to pass the Senate bill as is. I think we could have that also done by mid-July. And I think stable coins create an exciting new payment rail. And importantly, it will be a source of demand for the U.S. Treasury market. Because if you think about it, in terms of preference globally, would you rather have a private stablecoin that's backed by U.S. Treasuries with U.S. best practices regulation, or would you rather have an ECB or a PBOC, central bank digital currency, that if you write a mean, the ex post, the government can turn off? I think everyone is going to choose the U.S. private sector with U.S. regulation all day, every day.
Secretary Bessent, we appreciate you joining us here in our New York studio. That is the U.S. Treasury Secretary Scott Bessent.
All right, our thanks to Sonali Basak and, of course, to U.S. Treasury Secretary Scott Bessent. You take a look at what the stock market was doing during that conversation. We're still at intraday record highs on the S&P 500, currently higher by about 0.2%, having a gain we saw earlier in the session. But the color is still green, and that's all that matters when it comes to record high watch. The NASDAQ 100 up a little bit more, and I stress a little bit, with your big tech names higher by about 0.3%. You also have the Russell 2000, the small caps getting in on the action. Of course, it is a holiday shortened week. Thank goodness, but it's a very, very busy next 4 days.
I also think it's interesting that we continue to see Treasury yields move lower.
Yeah.
So right now it's just 1.5 basis points, but you're looking at essentially 4.25.
Yeah, the
on
level
the 10-year.
there is stunning.
Which is very easy in terms of the financial conditions that it creates, especially combined with what we see in oil, right? We had a few days where it spiked up higher. It's been in the 60s for a while, and it continues to move lower, with Brent at 67.71 and NYMEX crude at 65.35.
Well, to your point on treasuries, we've seen this quiet rally. We've seen yields moving lower bit by bit. I think that's one of the reasons why you've seen small caps perk up a little bit over the past few weeks, those lower rates helping some of those smaller companies.
This is why we have a cross assets person.
Here I am.
On TV. Katie Greifeld covers all the assets for us. Coming up, Marija Veitmane joins us from State Street. She says to keep calm and buy tech stocks. Then we have the CEO of Trex, the actual decking maker, on demand for renovations or lack thereof. Plus, Michael Kantrowitz of Piper Sandler joins us. He suggests investors be overweight financials, and what a day to make that call, as well as industrials. This is Open Interest. We are 30 minutes into the trading day, looking at new record highs on the S&P 500 as well as the NASDAQ. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. And Matt, it's so interesting. Is record getting boring to say as a word?
No.
Not yet?
It's still fantastic for my 401k.
Oh, well, we'll keep an eye. Coming up, we're going to talk more about this record run, progress on trade, boosting sentiment as a volatile first half comes to an end.
Meanwhile, on Capitol Hill, President Trump's big, beautiful bill nears the finish line, but major hurdles remain.
And Treasury Secretary Scott Bessent joined me just a few moments ago to discuss it all.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like. So President Trump, then the Speaker Johnson, Leader Thune, and at the committee level, Senator Crapo and Chairman Jason Smith have been fantastic to work with. And again, it all goes back to leadership.
All right, and there is a vote-a-rama going on in the Senate as we speak, so we'll bring you headlines out of that as we get them. Joining us now is Marija Veitmane, head of equity research at State Street Global Markets. And Marija, Scott Bessent, the Treasury Secretary, telling Sonali Basak just then that we're going to have a flurry of trade deals in the final week up to July 9th. But that we could go back to April 2nd levels. What do you make of this, the risk reward in this market?
I mean, when we see what institutional investors doing in State Street custodial database, risk appetite is exceptionally strong. We see investors buying risky stocks. They're adding risk in their fixed income portfolios. They're adding risk in their commodities. They're increasing allocation to stocks. So investors kind of give it a vote of confidence. We see a lot of buying of risk among institutional investors.
It's interesting at the same time, what the Treasury Secretary would not exactly comment on is where he thinks interest rates should go. We know what the president wants to see, lower rates. However, it's unclear how investors feel about the current state of the economy as well. Do you think that there's sufficient weakening of the economy and the underlying strength to see more rate cuts this year, more than two?
I mean, it's very interesting in terms of like investor behavior. Yes, we're seeing very, very constructive risk appetite for U.S. stocks. absolutely, and it's been very consistent. But investors are quite skeptical about dollar. They're quite skeptical about treasuries. So that's where the question marks are. And we're watching very carefully the state of the U.S. economy. It's holding up. I mean, we are not seeing like a massive deterioration, but it has weakened. So yeah, I mean, market is pricing 2 rate cuts. That feels relatively sensible to us.
Yeah, I don't see the skepticism in treasuries. I mean, we're at 4.26 on the 10-year yield. We continue to see these rates move lower. The 2-year at 3.72. Why all this buying if, you know, there's a precarious 2 cuts priced in this year?
Yeah. No, I think the dynamic is really interesting, and I think what we kind of this year has been the huge challenge for investors because we had this really huge disconnect between soft and hard data. Hard data was, I mean, it's not like U.S. economy is not growing amazingly fast as we used to it, but it's holding up. But sentiment has been weak, and now it's kind of recovering a little bit. But
Marija, so is this, you know, President Trump has asked or demanded that Powell cut interest rates by 3 full percentage points. They're talking about putting in a shadow Fed, naming the successor soon. And Paul Tudor Jones said if he were President Trump, he would get the yesest yes man there is. Is that good for treasuries or bad?
I mean, Fed independence was a keystone of kind of financial system for many, many years, and it was hard won. And any concerns about losing credibility of an independence of central bank has been a problem. So I guess that's an issue for markets.
Marija, the other thing I didn't get to talk to the Treasury Secretary about is the issue of the dollar, because it's interesting, even with the U.S. having a strong dollar policy, you're pretty close, if you look at the Bloomberg Dollar Index, to levels that we haven't seen since 2022. Is there an argument to be made here that a weaker dollar could be good for the U.S. if it boosts exports? Or do you think that the weaker dollar is simply reflective of an aversion to U.S. assets?
Yeah, I think, I mean, increasingly from what our thinking is that investors are quite concerned about U.S. assets and particularly kind of fixed income. So as I said, we see continuous selling of treasury. We see continuous selling of dollar. So investors already built fairly large underweight position in US dollar, and they continue to sell. I mean, in the last few months, we barely had a day or two of buying dollars. So investors very consistently unwinding dollar and big underweight positions there, and investors in general are not really trying to go against that trend. So definitely we see strong selling of dollar.
At what point, Marija, does this, it feels a little bit like a house of cards, right? People talk about Fed index, or Fed independence, I should say, through a grin. You know, everybody talks about the risks that there are, the left tail, but no one cares. We're looking at valuations. If I look at Microsoft, 37 times earnings. Broadcom, 42 times earnings. I don't even have to mention Tesla, right? Palantir, 236 times earnings. I mean, these valuations are just nuts.
Yes, valuations are expensive, but I think what we have in equities, and that doesn't go to every individual stock, but within equities, I mean, particularly in tech sector, you get fantastic fundamentals. You get strong growth, strong earnings, strong margins, and they come at a very high price. And on the other hand, another extreme, you have lots of companies which are extremely undervalued by historical standards. Think about your small cap companies, think about healthcare. I mean, there are lots and lots of potential, quote unquote, value to be found in the market. But it increasingly looks like value traps. Those companies have very serious fundamental problems, and cheap companies are getting cheaper and more expensive companies are getting more expensive. So for now, investors, because of this kind of lack of anything in between, a lack of opportunities outside tech, investors seem to be prepared to pay those high multiples for those fantastic companies.
Marija, one question I have is what is going to drive the next leg of this rally? Matt and I were joking a little earlier about how the board record is getting kind of boring. We're hitting another one today, except for if you look at the component parts of the S&P 500, it's a little weak. There's not a whole lot of love in certain sectors. Energy has been, of course, a dog for the last week or so, but real estate also, interest rate sensitive, utilities, staples now on the fence. So is it really just going to be financials and big tech? Do you have to float to safety in the big names, the tried and true names that everybody knows, or do you look elsewhere for the next set of returns?
Yeah, I think I'm very much in the boring camp. I think you have to stay with safety of large companies, which like quality companies, with very, very strong fundamentals. So yes, tech is very much on top of our radar list. We are quite skeptical about broadening of the rally, again, because we don't see broadening of underlying earnings. The minute you have broadening of underlying earnings, yes, of course, you jump into those kind of undervalued opportunities, but it doesn't seem to be forthcoming. So we're sticking with tried and tested strong earnings in tech.
Marija, great having you on as always. Marija Veitmane there talking to us from State Street. Let's get a look at what's going on in the markets today. I'm not sick of the word record, although I will admit we've been saying it every single day a lot recently. S&P 500, again at an all-time high, an intraday high, 6187. Of course, we closed at a closing record high on Friday. It looked like for a second that we wouldn't when Trump said the Canada deal was off, but then they capitulated and he followed suit. So.
But it's interesting, we hit the record even before they capitulated, which tells you that there's still the sense in the market that we'll get there somehow anyways, even if we don't know where that end rate is. I'm also going to give a shout out to the bond market at 426. I thought it was interesting to hear Bessent say that even by losing a 0.5 percentage point in the 10-year since the January highs, it's not enough. And so the question is, what else brings it down?
Right.
Open question.
Well, or what pushes it up, right? As we look for the passage of this big, beautiful bill, which could happen today, maybe later this week, but the president has said he wants it on his desk by the 4th of July. You got to take a view on whether or not this adds $4 trillion to the debt, which isn't what Scott Bessent wanted, right? He essentially campaigned on a 3% federal deficit, and we're looking at a 7% federal deficit right now.
And it depends at the end whose math you believe. Let's look at some of the single stocks moving this hour. We're looking at Tesla falling today as Trump's budget bill and cuts to EV credits near closer to passing. It's still only down, Matt, though, about 0.5%.
Yeah, Tesla, the biggest loser in the Magnificent Seven, but not a huge loser. Obviously, it's worth over $1 trillion, and it's at a valuation of 180 times forward earnings.
No one's crying for Tesla
right now. Juniper Networks gaining after the Justice Department settled its lawsuit challenging HPE's $13 billion takeover of the company, so it's free to run. And then Moderna.
It's climbing. Its experimental flu shot met its goal in a late-stage trial. Of course, that had once been a meme stock darling in the wake of the pandemic, but apparently still people keeping a close eye on what's going on.
Yeah, we could get one big, beautiful shot there from Moderna, and efficacy was 27% better than its rivals that are licensed now. More coming up from Shanali's fantastic interview with Treasury Secretary Scott Bessent next. This is Open Interest. Let's get to high interest right now. Look at what's making headlines around the world. A group of 22 large U.S. banks comfortably cleared the Fed's annual stress tests. The results set the stage for lenders to boost buybacks and dividends for shareholders. And as a result, you can see gains at all of these banks. I think that's one of the key issues in today's trade. Speaking of banks, ING is announcing it will cut 230 jobs focused on directors and managing directors, saying there are just too many of them. The cuts are prompted by market circumstances and the goal of rebalancing staff. This is ING over the past couple of days. Looks like the ADRs here. Big money takeovers of private companies help to drive M&A in the first half of this year, today being the last trading day in the first half, as deal makers got comfortable writing sizable checks in volatile markets. The optimism is set to continue into the rest of 2025, as Marija Veitmane was telling us from State Street. She expects M&A to really pick up in the second half. Shanali.
And meanwhile, in Washington, Republicans are scrambling to overcome internal fights for President Trump's massive tax and spending package. Last hour, I sat down with the U.S. Treasury Secretary Scott Bessent about what kind of progress was being made on the big, beautiful bill.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like. So President Trump, the Speaker Johnson, Leader Thune, and at the committee level, Senator Crapo and Chairman Jason Smith have been fantastic to work with. And again, it all goes back to leadership.
Now, when it comes to the fiscal hawks, has the administration made any assurances about executive orders or legislation down the road to address the national debt load?
Well, I think everyone believes that this is a start. So it's an 11% cut in non-discretionary spending. And we're going to go from there. So we didn't get here all at once. We've gotten here 20 or 40 years, and we are going to bend the curve, bring the debt levels down. I'm a fiscal hawk. I've had a lot of very good meetings with that group. And I think we're all on the same page on how to grow the economy while controlling and bringing down expenses.
Now, let's talk about some of the math there as well, because if the GOP is right and the bill does look to shrink the deficit, how will that affect Treasury issuance over the next 10 years? How does your math square with the CBO, with Wharton, with Yale, and even the Bloomberg consensus of GDP projectors here, economists, that still see growth under 2%?
Well, I think that's just wrong. And, we can start with the CBO. Is their model presumes 1.8% forever. And maybe under Democratic governments, that's right. I think what we saw under President Trump's first term is that we will get a big boost in the economy from the tax bill. We're going to have certainty. We're going to go back to 100% expensing. So we are also deregulating at the same time. So we saw it in Trump 1.0. I think that we can see it here. So I think we can really accelerate the economy because the CBO model shows 1.8% growth, whether we have the biggest tax cut in history or we get this across the line and give companies and consumers great certainty.
And that was Treasury Secretary Scott Bessent speaking to us just moments ago. We're going to now head to Washington as President Trump's tax bill faces a marathon voting session, a vote-a-rama in the Senate. Joining us now with the latest, Bloomberg's Washington correspondent Tyler Kendall. How's it going? What's the latest? Because every time you think that this bill is just about to make it through, there's a holdup.
Yeah, hey, Shanali. So we're probably in for the long haul here. This vote-a-rama is expected to take up to 12 hours to compete because essentially we have legislators on both sides putting forward amendments to get people on the books when it comes to certain priorities and also for some politically fraught issues. It's part of a bid by Democrats, at least, to try to draw out this process before the Senate bill heads to a finalized vote. And you heard the Treasury Secretary tell you that they are still optimistic that this is going to get to President Trump's desk by July 4th, but a few different things have to happen between now and then in order for this to get through, because at the moment, Senate Republicans don't have the votes, which means that Senate Majority Leader John Thune is working overtime at the moment while this vote-a-rama is going on to try to cut some negotiations and deals with those holdout Republicans, because keep in mind, he can only afford to lose 3 before having to bring in Vice President J.D. Vance as a tiebreaker vote. And we should say there's pretty broad agreement here when it comes to the big pillars of this plan, like the tax cuts. But when it comes to the spending cuts, some Republicans are on totally opposite sides. On one hand, you have those Republicans that are pitching themselves as fiscal hawks that want to see deeper spending cuts. And you ask the Treasury Secretary one of the biggest questions we're asking here in Washington, which is what sort of deals is the White House willing to make with these holdout conservatives? Since we heard from House Speaker Mike Johnson when the bill passed the House that potentially some executive orders could spur these hardliners to get on board with with the plan. He sort of skirted the question there, saying that this is the beginning of a conversation and that they're much more focused on stabilizing that debt to GDP ratio. And then Shanali squared that with the other side, which are those Republicans raising concerns about changes to Medicaid and how quickly some of these clean energy tax credits are being phased out. The Treasury Secretary told you he took issue with the word cut, but we have to keep in mind that a lot of these Republicans are using that word too because they are concerned about how tightening work requirements and a lower Medicaid provider tax could impact their constituents.
Right. I mean, at the end of the day, we're going to come to midterm elections, and a lot of these Republicans' constituents aren't going to want to vote for them again. How are they dealing with that kind of blowback? And especially considering the fact that they could be primaried by candidates backed by Elon Musk.
Right, definitely, Matt. It's definitely a factor here, and there's a few different threads we could pull on. One is the timing of how some of these tax credits, for example, are coming, or these tax cuts are coming into effect. For example, they're front-loaded. That was partly by design by the president, who has openly said that he wants to see them as quickly as possible to, one, spur investments, but also get cash into consumers' pockets as quickly as possible. When it comes to the cuts, we have seen some Republicans at least stand up to President Trump's threats of primary. For example, Senator Tom Tillis, a Republican from North Carolina, has raised concerns about what this will mean for his constituents. And then in a surprise announcement over the weekend, he announced that he's not running for re-election after President Trump threatened to primary him. No doubt, though, the timing of this is going to play a pretty significant role. Also, when you think about how they're adding a hike to the debt ceiling, this no doubt is going to come up again in Washington.
Tyler, we appreciate you and your reporting. Good luck today. That is Tyler Kendall in Washington. Let's get a check on these markets as well, because even though we are floating near record highs, we are at session lows. And so you're looking at a market here. Of course, we have payrolls later this week that is looking to digest not only the tax bill, but of course, future economic data. The 10-year yield now rising just a little bit more than we were before. We're at 427. Stick with us. Still ahead, we're going to bring in Michael Kantrowitz. He's Piper Sandler Chief Investment Strategist. He's overweight financials, industrial, tech. We're going to talk to him all about it. This is Bloomberg Open Interest.
Let's get a check on the sectors right now with the Move screen. It's the most dynamic way to look at any equity index on the Bloomberg terminal. You can see we have 297 gainers, 205 losers. So you don't have the kind of breadth that we've had the last few days of rallies. And as Shanali pointed out, we are near session lows right now. In terms of the winners, Meta right up there adding points. Oracle also at an all-time high right now. Broadcom and Palantir. I was just looking at Palantir right now trading over 200 times forward earnings. NVIDIA is only trading up about 37 times forward earnings, which to me, I guess, look cheap, although a client tells me that's consistent with the highs they've seen. Amazon actually down right now 1%, as Nintendo says they won't get the Switch 2, which is supposedly the biggest video game console release of all time. I feel like the Xbox and the PlayStation have had big ones too. In terms of the breakdown year to date, because we are in the last trading day of the second half, you can see industrials have really outperformed, up almost 12%. Communication services, these are the hyperscalers, so AI, and then financials doing incredibly well in the first half of this year, up 0.8%. The losers are consumer discretionary, healthcare, and energy stocks. So these are the defensive sectors, and investors have sold them. Coming up, Trex is getting dragged down as potential buyers continue to wait on the sidelines. Mortgage rates are high, and so are prices. Bryan Fairbanks, the company's CEO, joins us to talk about the housing sector next. This is Open Interest. The UMich home buying sentiment index is hovering around all-time lows. High prices and rates that just won't come down continue to make buying a house out of reach for many. As a result, pending home sales bounce along the bottom of record lows as well. The tough conditions also impacting related companies. Trex is the world's largest manufacturer of wood alternative decking. It's down more than 20% year to date, and the company's CEO joins us to talk about that. Bryan Fairbanks, I'm pleased to say, is with us. Bryan, great to have you on the program. how much of the poor performance in your stock is just investors reacting to this tough housing market?
Yeah, so even though we're not tied directly into new home builds, we're about 95% repair and remodel based. We definitely get dragged as the market moves around with the different, when investors are looking at new home versus repair and remodel stock. So it definitely has an impact. All we can do is focus on getting more product out in the market, and where consumers are spending more time in their existing homes, more repair and remodel is needed. And in the case of a wood deck, they do fall apart over time, and we're there to provide that replacement long-term material for them.
From your perch, how are consumers feeling? There are a lot of concerns around the disparities that you see in the sentiment data that's coming out, and ultimately it comes down to what people are willing to spend. Do you see that they're still trying to push things off given all the uncertainty that's in the macroeconomic environment and what might happen to prices on the heels of tariffs?
There's absolutely a disparity, especially between the high-end markets and the lower-end markets at this point. We see a difference depending upon that level of consumer. Fortunately, most of our consumers are going to be in that higher income, $100,000, $120,000 family income, kind of at the minimum level with that. And we've seen continued strong opportunities as we've gone through the busy part of the season, people wanting to upgrade the backyard of their home. And we've also heard from our contractors where their backlogs are staying fairly consistent between 6 to 8 weeks.
So you have, I mean, part of the tagline for Trex decking is made in the USA, right? How much do you manufacture here? How much more than your competitors? Does that give you an edge in the new tariff world?
All of our decking is manufactured here in the USA. The majority of our railing is also manufactured here in the US. We do import a couple of our railing programs from offshore. Those will be impacted by tariffs. Less than 5% of our cost of goods sold are impacted by tariffs. Given the size of some of these tariffs, it will have an impact. We'll be able to offset that through negotiations, pricing, and resourcing to other areas that have lower tariff impacts.
Some of the tariffs that are harder to parse through involve things that are very much involved in the housing market. One of the things I recently just asked Secretary Bessent about is the 232 tariffs on lumber and timber in particular. The other side of that story, too, is what's happening on the immigration front as well. There's a lot of concerns that the gum up you're seeing in the housing market might get worse if not continue. How do you feel about what you're seeing in housing more broadly and the prospects of the affordability crisis getting any better?
What I would prefer to see is I'd prefer to see more housing turnover. That would be driven by new home sales. I can't control that part of it. When you have that turnover of sales, you do tend to generate more repair and remodel spend along the way. But we also recognize homes are at their historical high from an age perspective, and there's a lot of repair and remodel pent-up demand that's sitting out there. So regardless of where the economy is sitting, some of this work must be done. And over time, that pent-up demand tends to come back, and we get back to more normalized averages over the coming years.
But as you point out, it's not, you're not directly affected by the slow housing market. You're really looking at people who are repairing and refurbishing. Don't you love tariffs on lumber? I mean, that's your biggest competitor.
Higher price lumber definitely doesn't hurt us. It makes the price differential between wood and composite closer. We do see that there is that value with composite products. Our research has shown us that a composite product, our Trex Enhance, which sells for about $2 a linear foot, about twice the price of wood, is that price range where we can convert that wood buyer into a Trex composite deck buyer. And then, of course, we've got products that range anywhere up from $3 to $5 to $7 a linear foot for more of those premium, the premium aesthetics and performance.
Brian, what about the people who are buying homes now and their disposable income, the income that is left to do anything they want to their house? Because, for example, I'm embarrassed to say I'm one of those dumbbells that has a mortgage at north of 6%. That wasn't always the case for people. It means more of my money is going towards paying my mortgage than it would to something else. So are you finding that people are going to have to make that trade-off as mortgage rates remain high?
It definitely adds to the challenge with the consumer. we do find when people are making that decision about their deck, they're making the replacement for in many cases, the wood deck, especially for many of those entry-level homes. That's part of the living space that they have for their home. So the home may not be as big as it had been 5 years ago, but that deck's an extremely important part of the living space they have. So having a great usable space where they can entertain is very important, and it does remain one of the higher probability type repair and remodel spending that people will do.
All right, Bryan, thanks very much for joining us. Bryan Fairbanks there of Trex, the world's biggest maker of non-wood decking. Some pretty fantastic products for. I was sitting in some Trex furniture this weekend at the Mohonk Mountain House.
Oh, you know I love that place.
It's
now you're just trying to make me jealous.
To go. Let's take a look at what's going on in the markets. If they continue to rise, I'll be able to afford that stuff. We are looking at only a 0.2% gain on the S&P 500, but at these levels, that makes sense. 6185 is near an intraday high the high that we achieved earlier. The Nasdaq also at a high 22,600, and one of the reasons may be this 10-year yield at 4.26. Okay, it's not off as much as it was earlier, but it's pretty impressive.
It's pretty impressive as to how much it has come off. It is lower, much lower than the highs, but actually a little drift higher. People are not really latching on to the deficit yet, which is something we'll talk about later this hour. For now, we're going to look at some single stocks moving this hour with Bloomberg's cross-asset reporter, Denitsa Sekova. You're looking at the financials. You're looking at Goldman Sachs.
Let's start with Goldman Sachs. Of course, banks passed the stress test late on Friday. We got results that the banks passed very comfortably the test. But the big winner, according to Citi, is Goldman Sachs. And it was already expected that Goldman Sachs would do quite well. But the margin by which it beat on the test were really impressive. There is a lot of optimism about banks. We had that recent note by Mike Mayo. There is like loosening regulation, strong deal making. As you said, interest rates are clearly very high. So Goldman Sachs just reached a record high last week. The banking index is almost at a record high. Goldman Sachs itself is up more than 20%. We saw RBC raising the price target today. We saw obviously the Citi optimism. So that's one field that's kind of been underperforming in the last few months. But in the last few weeks, there is a lot of energy and optimism going there and new record highs.
Matt, what I like to watch is Goldman versus Morgan Stanley. You have had Morgan Stanley trading at a higher price to book ratio, meaningfully higher, but you do have Goldman now catching up a bit. It's trading at 2 times book. That's a milestone, I'd say.
That's pretty fascinating. I remember watching Deutsche Bank trade at like half, and they probably aren't doing so much better than that right now. Circle has been an incredible story. Shonali and I have been following this, watching the stock trade at 6, 7, 8 times the IPO price. It came down pretty substantially on Friday, but it's bouncing back. What's going on?
Yeah, it's incredible because even today it started lowering pre-trading. It came off a JP Morgan initiating coverage of an underweight. So JP Morgan was obviously working actively on the IPO, but they have underweight on the stock. And the language around it is harsh. It says that is way above the comfort zone, the current valuation of the stock. But the price target, in my opinion, is where you see the real harsh criticism. It's $80 price tag. Currently, we're trading at $187. So that's definitely a lot of negativity. That said, we brushed it off. We're up on the day. The stock is up 500% since the IPO. IPO was obviously record-breaking. What's happening in Washington is obviously crypto has a new ally in Washington, not expected place with the stable coin legislation. We actually had Barclays giving an overrate rating. So there is some optimism, but clearly negativism is not able to hold for much long.
Denitsa, we thank you so very much for your time. That is Denitsa Sekova of Bloomberg News. And yeah, Circle is fascinating because you have to wonder whether they're going to get more competition from other people looking to issue stablecoins or whether they will be actually a core part of American infrastructure. A lot of big name investors talking about the idea of stablecoins to be massive buyers of treasuries and therefore something that is kind of more meaningful in terms of the financial infrastructure of the country, if you will.
All right, I'll watch your crypto show
on Tuesdays tomorrow, but Katie's filling in for me tomorrow. So I'm on vacation tomorrow.
Coming up, Michael Kantrowitz, Piper Sandler Chief Investment Strategist, joins us. He is overweight financials and industrials, which have outperformed the rest of the market year to date. We'll talk to him about tech stocks as well. This is Open Interest.
I think that we could see a further lowering of rates. I think inflation is very, very tame. I'm not going to comment on Fed policy, but I've said that I am focusing on the 10-year. So as we see inflation come down, I think the whole curve could parallel shift down.
Treasury Secretary Scott Bessent speaking with me a little earlier. Joining us now, Michael Kantrowitz, Piper Sandler Chief Investment Strategist, Head of Portfolio Strategy. I guess I expected Bessent to take a bigger victory lap of where the 10-year is, but it is still at around 4.25. Mortgage rates, they're still high. They're more tethered to long-term rates. But the bond market is not quite hiccuping over the big, beautiful bill right now. Where should rates be, long-term rates, to really spur more activity in this market?
Well, they've come down 20 or so basis points in the last few weeks when people were worrying about inflation. And part of that was we got some good inflation data. Oil prices are back down. Some of the high frequency, very tariff driven inflation data, like the prices components of the PMIs, have started to moderate. So it's more about the narrative and investors' view of where rates and inflation are going. And I'd say it's taken a pretty decent 180 just in the last month. And this is probably the 8th time in the last 2.5 years that's happened.
If you look at, Michael, valuations, they're very high. The risks of, the deficits and debt, even if Secretary Bessent says this one big, beautiful bill is going to reduce those things. The trade deals coming in, everything just looks a little bit dangerous. Fed independence. How come investors are willing to ignore these issues and continue to buy at these high levels?
Well, I don't think they're ignoring it. So number one, we're at new highs today, and actually the market is very little, but a little cheaper than where it was at the February highs by about 1.5% or so. So earnings estimates have continued to go up, and that's been up since the last high. So the market's a little cheaper. And also, we're dealing with a backdrop of a lot of uncertainty, and investors have been whipsawed and shocked by everything from tariffs, inflation in 2022, Fed rate tightening cycles, recession fears. So there's a little desensitivity, and there's a good amount of myopia. And right now, the what have you done for me lately mindset is things are in pretty good shape compared to where we've been and what we've gone through.
Michael, when you take a look at where things are trading today, I think it's pretty interesting because we're looking at fresh records, but you are not seeing the same type of exuberance in the market that you saw towards the tail end of last week. For example, most of the Magnificent Seven is down today. I'm wondering if you're starting to see trades start to peter out and even see more downside risk in this market, given where we are right now.
Well, I think we'll see. The day's not over, and it's only one day, and it's month end, and it's tends to be a quiet week of lower liquidity this July 4th week. So we'll see. Perhaps that's some of it. But yeah, the last few weeks, the market's gotten a lot more optimistic as we've priced in a rate cut for September, more so on low inflation than weak economic growth or weak employment. And so, I think the multiple should be very high for this market, considering its fundamentals, considering oil prices, especially on a real basis, are at multi-decade lows. And interest rates are high for some, but not all, particularly the Mag 7. I don't think they have a real big need for capital in terms of, having an interest expense problem. So multiples should be high. And the risk here is, in my view, not that the multiple is high, but what could bring the multiple down. And so traditionally, that's interest rates surprising and shocking up higher, Same thing with inflation, in unemployment spiking faster than is expected, or something exogenous like shocks or like tariffs or another geopolitical event that would push oil up. Right now, we don't see that as a big near-term risk. So the multiple should stay elevated. And if we keep getting better inflation data and tariffs don't really flow through to inflation as much as people are concerned about, they could actually go even higher.
Michael, what do you think about the outperformance that we've seen from European stocks or the rest of the world in general? You know, the U.S. is doing okay, I guess, 5% year to date, but every place else seems to be better. And when you only get a 5% raise and you're looking at somebody else with a 10 or 15% raise, yours doesn't seem as good.
Yeah, well, I would rephrase that a bit, because I think, you know, it's not European stocks as much as it is as the European currency that's explained a lot of that outperformance. So if you're a European investor and you're dealing in euro terms, the Euro Stoxx 600 is only up about 5% this year. In the U.S., if you're an investor owning an ETF in Europe, yes, they're up something like 25% year to date. The bulk of that came at the beginning of the year from the equities, when U.S. equities were falling and European equities were going up. Since then, actually, you've been better off owning the S&P 500 as a U.S.-based U.S. dollar investor. The S&P 500 has been outperforming since the middle of March, European equities. So, you know, we've kind of recommended own equities where the earnings are growing the fastest or outperforming, and that's true with respect to Europe. And then, you know, the weaker dollar and stronger euro is really what explains a lot of that ETF outperformance since the middle of March, not actually the stocks. So, and I think that's really important, because if you're an investor and you're long this equity index and you don't realize that the euro strengthening is actually carrying the bulk of the outperformance and the upside, it may kind of, you may be surprised at what could change that basket of stocks. So we would actually remain long U.S. larger caps, and for those investors looking for more cyclical exposure instead of U.S. small caps, we would look abroad in Europe to gain that exposure.
Michael, we thank you for joining us this Monday morning. That is Michael Kantrowitz of Piper Sandler. Now, coming up, we've been talking about that big, beautiful tax bill. The Senate is voting on amendments. We're going to get the latest from Washington next. Stick with us. This is Bloomberg Open Interest.
The Senate is voting right now on amendments to President Trump's big, beautiful bill. Majority Leader John Thune is working to get it passed by July 4th, but faces a torn grand old party. Joining us with the latest is Bloomberg's Washington correspondent Tyler Kendall. Tyler, remind us how the so-called woke parliamentarian concerns were worked out. You know, last week it seemed like they would either have to overrule her and or fire her. What was the solution?
Well, at the moment, Matt, it appears that Republicans have taken her recommendations, and they've changed the language in some of these provisions, including when it comes to the Medicaid provider tax. But in others, they haven't actually even sought her guidance, including something that they actually just passed moments ago, which is a plan to use what's known as the current policy baseline, which would essentially mean counting the extension of the 2017 tax cuts as costing nothing. This is something that the budget chair, Senator Lindsey Graham, said that he didn't even want the parliamentarian to ultimately weigh in on, as Republicans make the argument that extending tax cuts don't add to budget deficits in the same way that new tax cuts would. And it has some pretty significant impacts for the math when we look at it. The Congressional Budget Office estimates that the Senate bill as it stands would add $3.3 trillion to the deficit over the next 10 years. But when you take into account this accounting method, for example, then the numbers come out to a $508 billion deficit decrease instead. So it's sort of been walking a tightrope when it comes to the parliamentarian, as Republicans remain firm that they want their priorities in this bill.
Usually you don't want to get into the minutia of procedure and accounting, but in this case, it matters a lot, to the tune of trillions. Tyler, though, before we let you go, say this passes through the House smoothly, although there are definitely concerns still from certain holdouts. What does this look like when it goes back to the House? How much pushback would it get then?
Right, Shanali. So this bill is designed not to ping pong between the chambers. But with that said, there are still some members of the House that are already raising concerns with how the Senate is changing the plan. On one hand, it does appear that the so-called SALT caucus was appeased with a compromise that would keep that cap at $40,000, but it would end or phase out after 5 years instead of 10 years. But then the other means that we're really paying close attention to those House Freedom Caucus members like Congressman Chip Roy, who's now threatening to sink this bill if they don't see deeper spending cuts. It's hard to see how this is going to square at the end of the day. They are really focused on that rollback of those clean energy tax provisions. But we actually just got news that it does appear that Senator Lisa Murkowski, there are reports that she's going to introduce an amendment here that would actually slow down the phase outs when it comes to solar. So something to just pay close attention to as this develops.
We will be watching the Vote-A-Rama with your help, Tyler. Thanks so much for joining us, Tyler Kendall out of Washington. Tomorrow, we will be live from the ECB Forum in Sintra. Francine Lacroix is moderating a panel with Lagarde, Powell, and Bailey. This is Bloomberg.